This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Chaos escalated this week as the financial markets got very close to the worst-case scenario on the tariff front. Up next, we don't have the luxury of opining about ideology and what could or ought to unfold years into the future. We're managing money in real time. Let's take stock. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. What a week. Wow. I had actually had a podcast fairly well organized and written on Thursday, and I actually kind of ripped it up because everything I was going to say, I feel I need to say something a little bit different. Doesn't mean we've changed our opinion that much on things, but just given the news flow, I think it was appropriate to take a bit of a different tack. So this might be full disclosure, a bit of a disorganized show, and maybe even a shorter show because I just want to kind of focus on some of the key points. It's also, of course, first quarter earnings reporting season coming up just in the next week or two. So I think I'll punt on talking about individual companies today. Maybe next week when I come on, I can get into a few more company-specific situations. But for now, let's be honest. I think we all have more questions than answers. I mean, in fact, nobody has answers. I don't even think the most seasoned of economists, the most seasoned of Wall Street strategists, I don't even think anybody in the White House has answers. Mostly questions. So I thought that's kind of the approach I would take today is identify some of the key things that we're going to be asking and looking for over the next few months. Because remember, I appreciate that what the Trump administration is trying to do is kind of forward-looking, right? Trying to onshore manufacturing, rebuild our manufacturing base, rebuild a lot of those jobs. I get that. But for us, we're managing money for people. We're stewards of our clients' capital. So as much as investors, we like to think about future opportunities, future profits, what could happen, what should happen, what ought to happen. We don't have the luxury right now, right? Because we've got to make sure that we're focusing on not just being positioned for the long term, but risk management in the short term, making sure our clients who are real people with the real cash flow needs have what they need to be successful in navigating this tough environment. So just keep that in mind. But I thought I'd start out here. Actually, give me like a 2 or 3 minute diversion here. I just wanted to make a few comments from sort of an investor intelligence, emotional intelligence perspective, because I think, as I've said on this podcast and the radio show before it for years, often the biggest enemy of successful investing is not the markets themselves. It's not losing money on stocks or bonds or commodities or cash. It's making the wrong decisions at the wrong time. So just a few things to keep in mind. Again, these are more kind of what I'm hearing from people right now. I just thought I'd share them. One is, don't spend a lot of time saying, oh, I knew this was going to happen. Our client base is no different than the country, to be honest. It's probably 50% Republican, 50% Democrat. So I'll have one call supporting what's going on, the next call denouncing what's going on. Again, no different than any other office in the country, probably. But particularly from probably our more Democrat-leaning clients, I'm hearing, oh, I knew this was going to happen. You're not going to get a lot of mileage out of that. Okay, that doesn't help you. And what I would say further is nobody knew this was going to happen. In fact, I would argue that Donald Trump didn't know what he was going to say until maybe in real time yesterday. I'm actually fairly convinced there's probably different things discussed in the 10, 15 minutes before he got to the Rose Garden than what he actually relayed to the public. Okay, so a lot of this is, I don't want to say it's off the cuff. That may be a little unfair to the administration because it is consistent with a lot of the ideology and campaign promises that were made. But the actual execution of this tariff policy, I do think was probably to some degree spur of the moment. Okay, so don't waste a lot of time living in regret. Okay, the second thing I would say is, keep some perspective. I know it's very hard when, you have a day like Thursday when the markets were in free fall, but I'm not going to I know everyone's performance is different, portfolio performance, but let's just say that if you had a diversified portfolio, you had a bunch of stocks, you had some bonds, let's just say you were up 10% the last couple years. I know a lot of people were better than that, but let's say and maybe some people worse than that, but let's say on average you were up 10% the last couple years. Okay, so let's say you have a compounded return in your portfolio of over 20%. Well, if you still kept that diversified, stock and bond, let's say you had that proverbial 60-40 portfolio, 60% stocks, 40% bonds. Well, if you've still done that, if you've still been positioned that way, you're probably down low, maybe mid-single digits this year. Let's say you're down 6% this year, just for argument's sake. Well, if you're up over 20 and you've given back 6, is that a disaster? Or is that just a correction in an otherwise upward trend? Remember, 2022 was a bad year as well. That was a double-digit negative performance for a lot of people because you not only had stocks down 20%, but you had bonds down as well. However, the market had been up double digits in 2019, 20, and 21. So even that was most likely just a correction of the previous 3 years. I fully acknowledge things can get a lot worse before they get better. I get that. Maybe we go down and who knows what we go down from this point forward. But the reality is I doubt, and this is just my belief, I doubt if you have a diversified portfolio that you're going to give up all your gains from the last couple of years. So keep some perspective. This is why we do financial planning, so that we don't get too tethered to weekly, monthly, even yearly performance. We look at it in the perspective of the long term. The other thing I would say is, and this is kind of a response to some of the calls I've been getting recently, you may be familiar with that psychological term of anchoring, where we get sort of a mental anchor to something or emotional anchor to something. And financially speaking, in the investment world, we often anchor to the highest price we've ever seen. So in other words, if stock XYZ went from 100 to 200 and now is at 140, we don't focus on the 40% gain from that $100 starting level. We focus on the 60-point drop from the all-time high to where it is today. Be careful getting caught up in that thinking because, again, there are a lot of people that have done very well the last couple of years, at least from a stock market perspective. But, we're well off the all-time highs, of course, set in mid-February. I think it was February 19th. That was the all-time high for the S&P 500. You do not have a God-given right to the highest price that some asset has ever traded at. You don't. And keep in mind, when we talk about all-time highs, all-time lows, those are just snapshots in time. I mean, look at a stock like NVIDIA that has had an unbelievable performance. I don't know the exact percentage, but it's well over 1,000% since, I think, roughly 2015. Do you know that they've corrected, including this correction, by the way, they're down over 30% from where they were a few months ago. Including this correction, I believe they've sold off at least 25 or 30% 4 separate times since 2015. 4 separate times. And if you look at the long-term track record of Apple or Amazon or Costco or Microsoft, they've all had similar double-digit and in some cases, 40, 50, 60% drawdowns along the way. So each time, you're saying, oh man, had I just sold at the high. But what happens? Stock pulls back, and if it's a good company, like the ones I just mentioned, those stocks have eventually traded to new highs. I don't know what the future will bring, but I have no reason to doubt that some of these stocks won't trade at new highs again in the future. That's just part of the deal. Another thing I would say, it's really easy to look temporarily smart or dumb when you have a sharp pullback like this, right? In other words, if you had sold in January or February, whether it's your entire portfolio or an individual company or companies, you're feeling like a genius today. Conversely, anything you've bought probably in the last few months, you feel like an absolute idiot, right? Avoid the temptation of either patting yourself on the back or self-flagellation. I mean, I think the famous example of this is Warren Buffett. Warren Buffett, if you recall, I think it was October either October or November of 2008, right in the throes of the financial crisis. He wrote that famous op-ed in the Wall Street Journal, buy American. You should be committing money to the stock market. And he put his money where his mouth was and invested a lot of Berkshire Hathaway's money at that time. Guess what? The S&P went down another 26% from the time of the publication of that editorial to the ultimate trough. But every single investment that he made is worth much more money, not just today, but within a few years of him writing that op-ed. So, don't fall into that trap, because in our portfolios here, we've sold more than we've bought this year, but we have bought a few things. We look stupid right now, right? We bought some things 2-3 weeks ago that look stupid. But ultimately, I don't think we'll look stupid. Okay, so don't worry about that in the short term. Just a couple other things I would say briefly. One is forget about earnings estimates, and I'll talk more about this in a second. Very easy right now to say, oh my God, XYZ company is really cheap because, their PE ratio, price to earnings ratio was 20, now it's 10. The problem is the earnings estimates haven't come down. And I don't think any company in America, maybe there are some exceptions, but I don't think any company in America that does any trade, particularly foreign trade, has any idea exactly what they're going to earn over the next 12 months. You've got to use a very, very blunt knife at this point if you're trying to cut apart an earnings report. So don't get too caught up in, this stock used to be at 20 times earnings, now it's 10 times earnings, oh my God, it's a fire sale. It could be that the E in the PE ratio is likely to come down. And then the biggest thing, and Greg Smith, my colleague here on the planning side, he talked about this last week on the podcast. Make sure you know, or at least have, I know emergencies come up, right? I have kids, things happen all the time. But try to have some semblance of what your withdrawal needs are going to be over the next 12 months from your portfolio. I've said this a million times. I'll say it again. The reason that bear markets are so bad for a lot of investors is that they have to sell into them. That stock that you love that goes down 30%, you have to sell it at the bottom to pay the power bill. Make sure, so for example, let's say you have $1 million, and let's say your withdrawal rate is 5% a year. You need $50,000 a year from that million to supplement Social Security or a pension or just to pay the bills in general. That's a reasonable withdrawal rate, right? $40,000, $50,000 off of $1 million. Do you have that much liquid? Or at the very least, is your portfolio generating a good chunk of that from interest and dividends? And it doesn't necessarily have to be under the mattress. Do you have it in a money market? Do you have some bonds? Do you have something not in the stock market that you could get to raise that money? That's the question that we are asking when people come in to update their financial plans. And I would definitely, particularly if you're not a client, ask yourself that. Okay, again, you don't necessarily need 2, 3, 4 years worth of cash on the books. We do have clients like that. But you at least need 12 to 18 months worth of money that you can get to. Again, it could be in bonds, doesn't all have to be in cash, but money that you could get to without having to sell your stocks, because if this does get worse, and again, you're selling down your portfolio when stocks are down 15, 20, 25, 30%, you've lost all your recovery potential, and you've really, really cannibalized your principal. All right, I'll get away from that. Let me get to the topic du jour. As I mentioned, everyone, including us, has more questions and answers. So I thought I'd kind of share some of the central questions, if you will, that we're going to be focusing on over the course of, the coming days, weeks, and months. And so in no particular order, first off, I guess I just review sort of what happened yesterday, unless you've been in a cave and are just emerging and seeing the sunlight for the first time. President Trump announced his tariff proposal, right? And as I mentioned in sort of the intro, pretty much a worst-case scenario, if we're being blunt and honest. A worst-case scenario versus what expectations were going in. The markets were actually up the last couple days in the hopes that he would be more conciliatory, maybe is the word, that he was going to dilute some of the public rhetoric. Well, that was not the case. In fact, if anything, he kind of doubled down and Maybe it was a little bit worse than what people had hoped for. Okay? Specifically, the proposal is a 10% universal tariff on everything, plus higher rates for countries with higher tariff rates and or large trade deficits. So for a lot of places around the world, the tariff rate will be significantly higher than 10%. So for example, European Union imports will face a higher rate. Not only that 10%, inclusive of that 10, European Union will be at 20%. Trump is very near his campaign proposal of about a 60% tariff on China. Right now, he's close to 54%. So he also eliminated the what the so-called de minimis exception, which exempted very small-priced or low-priced goods. Okay? Interestingly, Mexico and Canada are the relative winners under the new plan. So they have that existing 25% tariff that he put in place before, but they will not be subject to an additional 10. So again, maybe it's not a huge victory for those countries, but they did not experience any sort of significant escalation. The rates come in a lot higher than the consensus estimated on a lot of places, particularly Southeast Asia. Japan, 24%, South Korea, 25%, Vietnam, 46%, and I'll get more to that in a second. Taiwan, 32%. Though there's definitely a question about whether these will be challenged in court. Trump is invoking the International Emergency Economic Powers Act to justify these tariffs. We'll see if there is a court challenge to that and whether that is, for lack of a better word, kosher. So that's sort of the framework. Obviously, what we don't know yet, and maybe we'll find out more here in the next couple of days, we don't know what the retaliation looks like, right? So that's certainly an open question. But yeah, I think I have probably 7 or 8 sort of thoughts here or questions in no particular order. I'll tell you what, let's take a quick break. Up next, I'm going to get to those. What are the central things that you need to watch as an individual investor for you to be properly informed about how to position your portfolio? Back in a second. Fed job cuts are on the way, and the Wise Investor Group has your back. We work with scores of federal employees and even more in the overall ecosystem. Let's make sure you have a solid financial plan and are well prepared for whatever happens in these uncertain times. Please find us at raymondjames.com/The Wise Investor Group, or just call us at 571-430-7200. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Okay, as promised, I wanted to get to some of the central questions. We don't have any answers. Okay, nobody has any answers. Anybody who tells you they know what's going on is trying to sell you something, okay? But as far as the central I think sometimes knowing what the question is very important in order to make intelligent investment. I think one of the biggest things is, are these proposals serious? That's an open question at this point, because some of them are pretty darn over the top. So, for example, Vietnam, if you add it all up, do the math, the tariff proposal amounts to close to 13% of their GDP. 13%. So, there's an open question like, are these structural? Are these designed to generate long-term tariff revenue generation, or are these a negotiating tactic? I think in some cases it is the former, but I think with some places like Vietnam, who, by the way, is an ally, okay, they're not a foe of the U.S. from an economic perspective. The rates are so high that they're not sustainable. They're simply not sustainable. And to be honest, it's a real, I don't know the right way to put it, but I mean, think about somebody like Apple. Apple was under a lot of pressure in Trump's first term to route a lot of their supply chain away from China. Well, guess what? They did do that. Apple followed through on that, rerouted a lot of their supply chain and manufacturing to Vietnam. Now they're paying a higher tariff, or will pay a higher tariff on that business than they were originally. Think about how crazy that is. Okay? And the other part of sort of the seriousness part of it is if you look at, and I'm not getting to get into all the details on this, but if you look at the actual methodology of how they calculated these tariffs, pretty much every economist that I have read, and I've read a lot over the course of the last 48 hours, every economist has said the way that they came up with the tariff rates was beyond amateurish. And these are nonpartisan people, by the way. Okay, this is not a left-wing think tank coming to this conclusion. It's basically third or fourth grade math that was used in some cases. And in fact, one analyst said it's the equivalent of a high school kid blowing off all his homework because he was watching the NCAA basketball tournament and then turning in a paper that he wrote in the bus on the way to class on Monday. Literally. This is from a senior economist. I'm not going to mention by name, but pretty darn telling. So there is a real, so when I say, are they serious? The way that they came to these percentages seemed to be not just amateurish, but almost illogical. Okay, so we'll see. We'll see. My guess is I'm holding out some hope that at least the tariff rate that we're seeing on some of these countries will come down at some point, by hook or by crook. Second kind of question we have is, what happened to animal spirits? I read a quote reread, I should say, a quote from Stanley Druckenmiller. He's a billionaire, hedge fund manager. And this is what he said right after the election, back in November. Quote, "I've been doing this for 49 years, and we're probably going from the most anti-business administration, in parentheses Biden, to the opposite. We do a lot of talking to CEOs and companies on the ground, and I'd say CEOs are somewhere between relieved and giddy. So we are a believer in animal spirits," end quote. Well, what we're seeing now is, I've been doing this for a long time. This has to be the sharpest drop in sentiment and confidence that I've seen in 32 years. Okay, because now you're seeing the exact opposite. And yeah, I know that they're, and let me step back for a second. I am not doubting the long-term objectives of the administration. I think there are a lot of people in this country who support the onshoring of manufacturing, the recreation, if you will, of our manufacturing base. There are a lot of people who support that idea. But I will say the execution of it, the methodology of it, the way this has been rolled out, and the ramifications of this are being highly contested at this point. So this idea that Trump is a pro-business president, stimulating animal spirits, stimulating investment, that is very much in question right now, very much in question. So is the idea of a Trump put. There was this idea that if the market sold off, that Trump would, reverse course. That was kind of the way it was in the first administration, okay? That's also in question at this point because he's actually said publicly, I don't really care about the stock market at this point. And his Treasury Secretary, Scott Bessent, has sort of said the same. Maybe not directly. That's a little bit of a paraphrase. But so that's very much in question. So those are open questions right now. From an economic perspective, I actually, when I was on a couple weeks ago, I talked about the sharp deterioration in the so-called soft data. Consumer sentiment, not just consumer sentiment data, but consumer sentiment, investor sentiment, and business sentiment related to what I just said about the sort of the reversal of animal spirits. We've seen some of the sharpest drops in those readings across the board that we've ever seen. You probably have to go back to spring of 2009, the trough of the financial crisis, to see similar drops of that magnitude. And I said 2 weeks ago, at some point does the soft data, what people kind of say how they're feeling, morph into hard data. What are they actually doing? And maybe more pointedly, do we go into recession? That is probably the biggest question this year. mean, if you look at it from an investment perspective, I mean, the outcomes are binary. I read something from the guys up at Ritzold Asset Management. They looked at all the 10% corrections going back, I think, to 1950. And most of the time, those 10% corrections did not get worse. You know, we went, maybe they went to 12% or 15%, but we rallied off of those. The times that they did get worse were the times when we went into recession. And it's binary. I mean, literally, S&P gets to 10%. If the economy is not in recession or not going into recession, we rally, we recover. We do go into recession, it gets worse. So the difference between a slowdown and a recession could be a double-digit difference in terms of S&P 500 performance. We just don't know the answer yet. I can tell you that most people's base cases that I'm reading, you know, the folks here at Raymond James, Goldman Sachs, the good folks up at Strategas, pretty much all, in fact, even the betting markets, you know how people bet on the elections and now they're betting on recession odds. Those have all gone up from anywhere from 20 to 30%, maybe 2 or 3 weeks ago, up to anywhere from 40 to 55%. I think the betting markets are at 50%, so essentially a coin flip. So I don't think it should be a base case that we're going into recession, but certainly the odds have gone up, and that will be a pretty significant input as to stock market direction. So that's another thing that we'll be watching very carefully. Another sort of central question is, you know, what's going to happen to inflation? You know, Goldman Sachs came out, I guess it was Thursday morning, I should say. I think it was Thursday morning. And they suggested that if all these tariffs unfold as kind of written, and by the way, this is before any type of retaliatory tariffs, so just what Trump came out with, they estimated somewhere between a 1.5% to 2% increase in terms of the inflation rate. That's pretty significant, right? But what's interesting is, you know, the bond market is not sending that signal. Bond yields, both short-term bond yields and long-term bond yields, came down sharply on Thursday, which basically indicates to me the bond market at this point is more concerned about growth than inflation. If the real risk was, or the real concern was that inflation would go through the roof, I would think long-term bond yields would have gone up a fair amount. That's not what happened. Bond yields, including the 10-year Treasury, it was at 4.3% a week ago. Now it's down closer to 4%. And I think the reason for that is, yes, as you could have kind of an initial price spike, but if the economy slows and let's say we get layoffs, let's say we get lower energy prices, let's say we get kind of substitutions, meaning people balk on spending on pricier goods and instead start buying cheaper goods. Those things are all deflationary, not inflationary. So we'll see what happens. That's another, again, it's a question, it's not an answer. But you could definitely see a short-term pop in inflation, but ultimately lower inflation. And that's kind of the signal that the bond market is sending at this point. That's something that we'll be watching. And of course, related to that is question number 5. What the heck is the Fed going to do? You know, they're in a tough spot, right? You know, you've had people talk about stagflation. I just mentioned that I don't think that's our base case because I don't think inflation would be sustainable given a possible economic slowdown or even recession. But, you know, in that type of environment, let's say we do get some stagflation, slower growth, higher inflation. Very difficult for the Fed. I will tell you, and I've said this for years, that the 2-year Treasury yield is a pretty good referendum on where the market thinks the Fed will eventually get. And just a week ago, the market was pricing in, I think, about 60 to 65 basis points of Fed easing, meaning somewhere between 2 and 3 rate cuts. As of late this week, was closer to 80 basis points, so somewhere between 3 and 4 rate cuts between now and the end of the year. So we'll see. I think the odds of the Fed cutting rates have gone up, but I do think they're going to be patient, and that's why I think there's actually there's probably more risk to growth than inflation, because I think the Fed is going to be reluctant to cut rates too soon, and as such, they might end up being a little bit late to the party, right? They may cut rates and be behind the curve a little bit. So again, that kind of accentuates that growth risk. We'll see. And then, of course, central to us as investors, you know, we've talked a lot about the difference between the economy and the stock market, right? They are not one and the same. And one of the reasons for that is companies have a lot of ability, a lot of levers that they can pull to produce profits, right? I mean, they can cut costs, they can route supply chains, they can do all kinds of things. They can buy back stock, right? So what happens with profits? This is a big deal because we've been right around all-time high profit margins. Forecasts for this year's earnings growth for the S&P in aggregate are still running around 10% year over year. But interestingly enough, short-term forecasts, like the next couple quarters, have been coming down. Longer term, like the back half of the year, have been staying up. I think this changes that calculus, right? Because if the economy is going to slow, I think profits have to come down. Profits have to come down. So if you, this is why I said earlier in the show that you can't just look at a price to earnings ratio and use that as a basis for thinking that a stock could be attractive, because the E in the PE ratio is probably too high. Now, obviously, a number of companies are less cyclical, so maybe a utility or a telecom or a pharmaceutical, those earnings would be less susceptible to what's going on right now with trade policy. But all companies to some degree will probably be affected. So you have to take earnings outlooks both at the macro market level and the company-specific level with a gigantic heaping of salt. Okay? Again, we'll get first quarter earnings reports here, over the course of the next couple of weeks. It'll be very interesting to see what companies have to say. Not only have to say about their guidance, and my guess is companies are going to be pretty conservative. Now, probably it doesn't do them any good to be too optimistic and then disappoint down the road. But also, I'm interested to see what companies will do to defend their profits. Will they raise prices? If they don't want to raise prices too much, will they cut costs? So I think, employment has to suffer here. And I think that's going to be very interesting for the Trump administration, is if they're promising a return of manufacturing jobs, yet in the short term, General Motors and Ford and 3M and General Electric are laying people off, that politically is going to be very tough for them. Will Congress, will the Senate, will voters, will donors have the same patience that Trump and Lutnick and co. are asking for? We'll see. We'll see. I do know that profits are a leading indicator of business spending. So any hit to profits or potential hit to profits will lead to less CapEx, will lead to more layoffs. So question number 7 is very much related to that. Does this trigger a massive fiscal response from Congress? We've all read about, the back and forth in Congress right now, and, Trump's stated objective of, preserving the tax cuts that are in place today and extending the tax regime from today. But I got to tell you, that's probably not going to be good enough. Remember, and let me be very clear on this. The amount of tariff revenue that they're talking about creating here, somewhere between $500 and $600 billion from this new policy, okay? That is more than the entire amount of corporate tax revenue collected last year. Think about that for a second. So by extension, this is effectively, this tariff policy is a doubling of the corporate tax rate. So in the absence of any fiscal stimulus, maybe we get some monetary stimulus, maybe the Fed cuts rates, that's not going to be good enough. There needs to be fiscal stimulus from this administration to avoid a recession. And that might come in the form of lower tax rates for corporations, lower tax rates for individuals. My guess is that they really do want to incentivize companies, doing more manufacturing in the U.S., there needs to be some tax incentives that come with that, depreciation or, something that would incentivize a foreign automobile company, for example, to come in and build a multi-billion-dollar production plant. So that is going to be very interesting to see. And, I was stunned. I guess it was Thursday morning. I was hearing from the folks at Strategas, the research sort of think tank that we pay a lot of attention to. And they said they had conversations with congressmen They didn't identify by name, but congressmen who were stunned about the market's negative reaction to the tariff policy. So these guys are not living in reality. They're living in an ideological bubble. And again, let me be clear. I'm not doubting the merits of the ideology. I don't have a comment on that. I'm just stunned that these congressmen wouldn't realize that it's a very circuitous, difficult, and potentially hazardous path to get to where they want to go. So hopefully the market's reaction will be a wake-up call that, hey, listen, we need to, replace some of the air that's being sucked out of the economy, okay? And then, I mentioned the market had a sharp reaction on Thursday. S&P is now down, 12, I have to be loose in my numbers because it can change on an hour-to-hour basis. But the market's down somewhere between 10 and 15% from the all-time highs, set February 19th. So an open question we have, and we just don't know the answer yet, is what's been priced in at this point? And I think it's fair to say a lot of the tariff impact has been priced in at this point. I mean, you look at, for example, the Magnificent Seven, all of them, all seven are at least down more than 20% from the highs. So you can't tell me that some of this hasn't been priced in, particularly the tariff impact. I think what's fair to say is a full-on recession has not been priced in. So this can get worse before it gets better if we shift into recession. If we kind of, grind along with lower growth, frustrating growth, but not ultimately a sustainable contraction, we're probably closer to a bottom than not. And then just from an investing standpoint, these aren't really questions, but just things to kind of think about. One is, and I've been pretty firm on this for the last 7-8 months, that bonds look a lot more interesting to me than they have in a long time. I always go back to that Vanguard study. Vanguard every quarter updates their kind of 10-year forecasts for different asset classes. And again, it's not meant to be an exact science, but just based on valuations and their assumptions. Well, their most recent one, which is actually at the beginning of the year before all this tariff situation, they had U.S. growth stocks minus 0.4 to plus 1.6% annualized return expectation over the next decade. So basically nothing. But they had bonds, U.S. aggregate bonds, which would be an aggregate of corporate and treasuries, between 4.7 and 5.7% a year. So there's this kind of assumption out there that, bonds are just there for safety and stability, not going to get you much in terms of return. I don't know if that's a valid assumption, folks. I mean, I hope I'm wrong. I hope stocks do a hell of a lot better than that, particularly growth stocks over the next 10 years. But I think at the very least, it's fair to think, can't make any predictions in this business, but it's fair to think that bond returns can at least be much more competitive with what we get from stocks over the next 10 years and may even have a chance of outperforming stocks over the next 10 years. Again, that's not our base case, but that's reasonable. And if you look at what yields, and then look at just what has transpired here over the last couple of weeks. As stocks have gotten clobbered, bond yields have actually come down, which means prices have gone up. And there's some interesting dislocations out there, too. If you look at municipal bonds, for example, tax-free bonds, because there has been a little bit more supply than demand recently, which they think is, a lot of strategists think is a short-term thing, municipal yields have actually gone up a bit, particularly long-term municipal yields. If you were in the max tax bracket and you're willing to go out longer term, 12, 15 years plus, you could get the taxable equivalent in many cases of over 7% now. Over 7% a year. On investment grade paper, we're not talking about, junk bonds here. We're talking about AA type paper. You obviously have to do your own shopping and your own pricing. I'm just making kind of a general comment here. But if you tell me I could get 7% annualized yield for the next 15 years on an investment grade bond, I don't know. It seems pretty attractive to me. So think about bonds. I think you have to question a bit what's going on in emerging markets and even developed markets overseas. If you look at what's happened so far this year, the U.S. stocks have done poorly. a lot of international markets have done a lot better for the first time in a long time, right? We all know that international markets have underperformed, and there's been a lot of talk that this may continue, and it may continue in the short term. The dollar has been weaker. But some of this tariff policy is really damaging, particularly to emerging markets. Vietnam, Taiwan, Southeast Asia, probably Latin America as well. I'd be very careful about, I'm not saying you should dump your international exposure, but I'd be very careful about kind of chasing this recent rally here, because if we do have these tariffs continue, if the economy slows down, and if there's not only less importing by the U.S., but also less exporting from the U.S. to those economies, that's going to be a really tough growth drag, even if those markets are cheaper, even if their central banks are stimulating. Just be careful. Just be careful. One other thing I'll just mention briefly, technology has not led in terms of relative performance really since last May. It's been a long time. And so technology didn't lead going for much of the last 7-8 months, has not offered any sort of stability during this pullback. And I think it's reasonable to assume that they're not going to be the leader whenever we come out of this. So am I telling you to dump tech? Of course not. We own Mag 7 stocks in our portfolio. We own technology in our portfolio, and we'll continue to hold them because, quite frankly, we've been through this a million times. I mentioned this a few minutes ago. Double-digit corrections in Amazon and Apple and NVIDIA and Broadcom. I mean, those have been the norm over the last decade. Okay, so we're not giving up on a lot of these things. But sometimes the temptation is to grab the knife that's fallen the furthest. I would be very careful about that if you're putting new money to work. Okay, I would not necessarily just buy the tech stocks that have been clobbered the most. I might use this as an opportunity to actually make sure you have the proper balance in your portfolio. Do you own value stocks? Do you own some of these other things that may have lagged for much of last year? Okay, so listen, I know I covered a lot of ground here over the last 40-some minutes, and actually went a lot longer than I thought I was going to go. I'm back next week, and we'll try to get into some company specifics. Like I said, we're going to start hearing from companies with their first quarter reports. They probably don't know any more than we do in many cases, but at least it'll be good to hear from some companies. So I'll promise to share those things with you. In the meantime, stay healthy, keep a level head, and as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.